Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Sylvia Jablonski, CEO and CIO at Defiance ETFs. We're talking about the broader market and some very interesting new ETFs. Sylvia, welcome back. Great to have you on the show.
Hi, Nina. Thanks for having me. Glad to be back with you.
So we are recording this on the last trading day of September and the third quarter as well. And stocks have struggled in the third quarter, and September is on pace for its worst month of the year. And stocks have struggled mainly because now the Fed is expected to keep interest rates higher for longer, and that is particularly troublesome for technology stocks. So that is why technology is the worst performer lately, though the rally earlier this year was driven mainly by mega cap tech stocks. So and now we are heading into the final quarter, which is historically the strongest quarter of the year. So I wanted to start with your thoughts on recent market performance and your expectations for the fourth quarter stock market performance.
Sure. Well, good riddance to September. And right before we hopped on the podcast, we talked about this terrible hurricane that we have here in New York City. It feels like the appropriate way to end this type of month in the market, if you ask me. But it's not. It's sort of wholly unsurprising, right? August is usually a gamble, a kind of weak month, and September tends to be a down month. More often than not. So, and then that's coupled with a few things, as you said. We have a Fed that came out and was hawkish again and talked about, removing 50 basis points of easing in the dot plots. We went from, 4 to 2 cuts, and talked about neutral rate being higher and rates higher for longer because the economy is too strong and all of this. So as you said, that just doesn't, fare well for the market in the near term. There tends to be an overreaction, particularly in tech and semiconductors. But, my outlook is that, I expect corporate earnings to be pretty good this time around. I think that we are arguably currently in a soft landing type of scenario now. Of course, the Fed can change all that by, pressing down on the gas for a little bit longer. But as an investor with kind of a longer term outlook, I think that months like this are the times when, as they say, you get rich, right? These are the dollar cost averaging months. This is when you kind of have to have the kind of the will, if you're a very long-term investor and willing to ride this out, because it almost, kind of doesn't matter if that's your mindset in the near term, right? Because eventually the Fed will start cutting, and eventually is not far off at this point. So it's reasonable to say that, a year over, looking back a year from now, I think that, tech, I would expect tech to be sitting at much higher levels than it is now. So Q4, I expect a better Q4, stronger Q3 earnings. I think you'll have some of the tailwinds of seasonality. The consumer does still remain strong. Wages still remain steady. Inflation is coming down. So, some of the data that the Fed looks at is going in the right direction. Other data isn't. But I think overall, the downward trend is sort of favorable to the economy. And I do think that soft landing can be achieved, and I do think that getting closer to the inflation rate can be achieved. So I'm bullish on the end of the year. I think we're going to have a rally from kind of these 5%, 10% pullbacks that we've seen in the biggest tech names and S&P and such.
So where should investors be putting their money to work now? Are there areas of the market, any particular areas of the market that you like a lot now, particularly after the recent sell-off? Are there any particular stocks that investors should be looking at?
So probably the unpopular opinion, because of, in exactly what you mentioned in your intro, that tech led the markets, but now it's kind of been, beat up, and then sort of who knows what will happen with the Fed. But, for that reason, actually, I do like tech. I do think that tech, meaning Apple, Microsoft, Google, Amazon, I like also NVIDIA. I like AMD, Qualcomm, off of the recent Apple news and things like this. And the reason why is because I think that we're in this new era. The next 5 to 10 years will be all about artificial intelligence. And I don't mean that as like the buzzword of artificial intelligence. I mean the actual kind of like practical application and revenue generation from AI that, kind of supersedes the buzz and starts showing up in earnings calls. It starts, kind of improving pharmaceuticals, healthcare, surgical outcomes, more efficient retail targeting, more efficient, risk management at the banks and things like this. I just think we're in this new era, and the things, kind of the staples of pushing that forward are going to be technology and are going to be semiconductor stocks. So I do think that the 5 to now, 12% or so pullback in most of these single names is just an interesting time, especially if you had, kind of FOMO the first 3 quarters and didn't go into it. So I do like that. But then, of course, diversify, right? It's perfectly reasonable to keep some of your 5% in short-term treasuries and gather that yield. And it's perfectly reasonable to allocate to, defensive sectors like healthcare, where, recession or not, people are going to kind of need to be, taken care of and things like that. But and they tend to pay nice dividends and things like that. But, the Pfizers and the Mercks of the world. But yeah, tech and semi would be my top 2 picks.
So let's talk about these zero-day options, stock options now. And Defiance launched 2 ETFs that hold these options and aim to extract extra juicy income out of those options. So before we discuss those ETFs, I wanted to talk a little bit about these options because their trading volumes have been surging. And according to FT, the zero-day options or ZeroDTE, as they are popularly known, their trading volumes have recently accounted for almost half of total S&P 500 index options trading. So could you explain to our listeners what exactly these options are and what's behind the surge in their trading activity?
Yeah, sure. So ZeroDTE options are essentially, options that have 0 days to expiry, basically. So they expire on the same day, more or less, that they're traded. And then, the value of the option is determined by the underlying asset price on that particular day. So, they can be really powerful, basically. They have essentially very quick decay. So what you're trying to do is you're trying to capture that, kind of last bit of volatility before they expire within a 1-day period. So, kind of like why they're so popular now, basically, is, they sort of didn't exist before, right? They've only been listed on S&P, Nasdaq, and Russell for about a year, so a little more than a year or so. And I think investors who trade these tend to be pretty savvy, and they've just kind of figured out that, like, you can get some of the same characteristics of covered call strategies, but flip it inside out for some innovation, and do a put right on these zero DTEs and generate, to your point, kind of juicier income than you do with options that expire monthly. And the real difference is that, really, if you have a monthly option, right, you kind of have one chance each month to generate that income or, get your return. And with the daily ones, they cash settle every single day. So you have 30 bites at the apple, essentially, instead of one.
There are 2 concerns with these options. And these many experts have talked about those concerns. So the first one is that the surge in this trading activity could be exacerbating the stock market volatility and also probably making stock market moves more difficult to predict. So in fact, according to Goldman Sachs, the zero DTE options were responsible for acceleration in the S&P 500 sell-off on August 15th, when the index fell about 0.4% in just 20 minutes. And another concern is the rise in trading activity, the options trading activity by mom and pop speculators. So earlier options were traded mainly by high frequency traders. And we know that high frequency traders have access to all the sophisticated tools and data that they use for trading these options. But now retail investors or individuals, the investors, they make up about 27% of all options trading activity. That is according to Bloomberg. And then there are studies that most of these mom and pop investors, they actually lose money trading options. So I was interested in your thoughts about these concerns with the surge in trading activity of zero DTE options.
Yeah, so a couple of thoughts on this. So in terms of, one of the highest volume days in zero DTE options that everybody has talked about, on that particular day, this SIBO actually put out some information on that, and the net bought exposure was actually less than 1% of gross total volume. So although there was this aggregate volume that looked, or there was this volume that looked incredibly high and imbalanced, the actual aggregate volume was pretty even. Again, the bought exposure was less than 1%. So it's kind of difficult to argue that it had a huge impact on the market. It's super interesting because, and this is kind of totally unrelated, but my background was levered inverse ETFs too, right? And there was always so much talk about how the daily rebalance would move the market, and in all of the studies, it was like less than 0.25% or something like that was attributed to the actual rebalance trade. And, this is kind of a similar thing. I think just because there is so much volume, there's an assumption that it's somehow negatively impacting the market. But so far, it seems to be volume on both sides that nets out with very little gross exposure, either on the upside or downside. And SIBO just put out great information about that. They had to the tune of $1 trillion in AUM trading. In terms of the retail clients trading options, I'm not sort of familiar with the statistics on kind of like how all of that ends and how that changes between a retail retail person dabbling in options versus a retail person dabbling in stocks, and kind of net who does better, which was riskier, and things like that. And I think with that question, what I would say is, there are retail traders that are incredibly skilled and as or more skilled than, the most efficient, well-educated trader amongst, kind of all of us, or the hedge funds and whatnot. And then there are retail traders that perhaps have less knowledge and it feels like a bit of a gamble for them. And what I would say to the second crowd is, if, as an industry, I think having ETFs out there, whether it's, Defiance's zero DTE options, or it's some of the covered call strategies that are out there by our competitors. I mean, investors have the ability to have this professionally managed, right? They can buy an ETF where, the person who trades our ETFs is probably one of the top options traders in the industry, right? So Jay Prestrocelli. So, you kind of want that person in your corner, right? And a way to get that person in your corner is to trade some of these sophisticated ETFs that do it for you. And if, if you are a sophisticated retail trader, then, sure, you can perhaps do it on your own.
Good. So now let's talk about these two ETFs. These are actively managed ETFs, and they basically write puts on the S&P 500 and the Nasdaq 100 put options, and that is used as a yield generation strategy. And very interesting ticker symbols QQQY and JEPY. Please tell us about these ETFs.
Sure. So the goal here is that, we're looking to return enhanced income to our investors. And, what we've been doing is we essentially looked at some of the covered call strategies that were out there and saw, kind of how brilliant some of these strategies are, and, turn that on its head and in an innovative way, and saw something that's really been hiding in plain sight. And what that is that, there's a way to essentially generate a higher income environment by using in the money puts. So the way that this works is that first we start with cash and treasuries, right? And so the covered call strategies that are out there start with S&P. So the dividend that they get is 1.4%. But if you start with treasuries right now, your yield is over 5%, right? So we're starting kind of in this higher income environment at baseline. And then what we do is each day we plan to sell, at the money in the money puts on the index with an expiration of 24 hours. So what should happen is that at the end of the day, we have the opportunity to pocket premium, whether it's, kind of 0 to 1%. And then, the options are cash settled. So there's no stock assignment. That's a popular kind of misconception. Like, well, what if you're put the stock all the time, right? There is no stock to be put. These are cash settled index options. So essentially it's the math on this is the difference between the index and the strike we pocket. The premium is the additional, kind of income that it's generating on a daily basis. So, what we're doing again is just holding cash and treasuries as collateral. The most you can lose is the value of the fund itself. The risk is the risk of the index, but on a daily basis, you're trying to generate, our target is 25 bips, right? And that can be higher or lower, but we're seeking between that 0 to 1% opportunity on a basis, on a daily basis to capture that 25 bips of extrinsic value. And we actually just did our first distribution. Today is the X date, or today's declaration. And, so far we're tracking for a 67% annualized on QQQY and 55% on JEPY. And that's essentially been, the capture of selling in the money or at the money puts, coupled with that, kind of treasury yield on a daily basis.
Wow, those are very, very juicy incomes. So these ETFs will do well when the stock market is going up. Is that correct?
Well, so they tend to do well they'll do well in various markets, right? So you have a capped upside, which is the same as it is with covered calls, right? Because you are essentially, getting the upside up to the strike, right? And then on the downside, you should have less drawdown because, and I'll give you an example. Last Friday, Nasdaq was down 1.7%. We were down 1.4% because we generated that 0.3% of premium, that 30 bips that day. So, so on the downside, you get hedged a little bit and you can generate premium. On the upside, you're kind of capped. But yeah, the best situation is either, small movements up or down or a sideways market. It is kind of when you'll just be able to capture, the max amount of premium. If the market is upward trending, of course, you're going to capture the upside, but it's not going to necessarily outperform on the equity side, right? The whole goal here is to get you that, 40, 50, 60%, whatever it is at the end of the year that we can generate income on this, and for you to have a ride that's similar to the underlying index.
Very interesting strategy. Now, another ETF that you launched recently, and I wanted to talk about it, is the Defiance Pure EV ETF, and the ticker symbol there is EVXX. Please tell us about this ETF and why you decided to launch this ETF.
Yeah, sure. So I actually love this ETF. So it's EVXX is the pure EV ETF, and the word pure is there because we, and kind of answers the question why we decided to launch it. We looked out in the marketplace and we realized that, there were several electric vehicle ETFs out there, but all of them were kind of designed to, meet the characteristics and the rules of the 1940 Act fund, right? So you have to have diversification, a certain amount of components and such, but that means that you get Tesla, you get whichever kind of ETF company, all the EV ETF companies call it, but then you also have NVIDIA and Apple and Hewlett Packard and maybe Disney in there. And if you're thinking about wanting a pure play exposure to a sector, that's not really it. So we actually saw this hole where there was no pure EV ETF. And then with EVs right now, they're volatile. Some of them aren't sort of, wholly kind of like liquid with solid earnings and revenues and things like that. So what we wanted to do is look at the top 5 by market cap electric vehicle manufacturers that generate essentially 50% or more of their revenues from electric vehicles. So you're talking about right now, the top 5 are Tesla, Rivian, Li Auto, XPeng, and NIO. And it's rebalanced it's equal weighted on day one, and then it kind of runs and it's rebalanced on a quarterly basis. So every quarter we're scoping. So it could be that, and just to like kind of explain how it might work, like if Rivian starts losing to Lucid and then Lucid is the top 5, that name gets added in. So although it's actively managed, we keep the pure play, the transparency of how we're actually actively managing it, kind of, sort of public and transparent and all that. But that's essentially how it works. And then, why EVs? It's also in 2022, 14% of all the new cars that were sold globally were EVs. And we think by the end of this year, that'll be 18 or 19%, which is, double of what it was in 2021. There are more than 26 million EV cars worldwide. Countries like Asia, more than 60% of EVs sold or of cars sold are EVs. In the Nordics, it's like 90%. In the US, the story there. We have infrastructure bill, we have tax incentives, we have the global desire to become more environmentally friendly and go carbon neutral. So it's a sector that's just primed for growth. I do think it'll, when you opened up about in your introduction about the market and tech and things like that, I think it's, it can be poised in the near term to get hit if rates are high. But I think in the next 5 to 10 years, if artificial intelligence and, machine learning and quantum computing are the future of technology, then AI, it's going to be a similar thing. Electric vehicles will be the future of automobiles, and especially for the next generations. I wouldn't be surprised if, my kids never drove a gas-powered car, and by the time they're old enough to drive, they didn't even see them on the road. And that's a long ways away, obviously, but it's the next decade is a big growth opportunity for this space.
Yeah, I totally agree with you. EV adoption has been rising, and in the coming years, we will see that more and more people, consumers, prefer electric vehicles over traditional cars. And I'm looking at the holdings that you mentioned. So Tesla is the top holding. It accounts for about 23%, little more than 23% of the portfolio currently. And of course, we know that Tesla is a clear leader in EV sales in the US. But if you look at the global EV market, that is dominated by Chinese EV makers. So that is why we see so many Chinese names, the big Chinese makers in the ETF. So I had 2 follow-up questions. First is that I do not see BYD among the holdings, because we know that BYD is the biggest Chinese EV maker, and BYD actually sold more EV both pure EV and hybrid EVs. They sold more than Tesla, and this is a company which is backed by Warren Buffett. So it's an interesting company. So why BYD is not included in the portfolio? And the second question is that there's a lot of exposure to China, which makes sense because China is the Chinese EV market has been growing. In fact, 1 out of all 3 cars sold in China this year was an EV, and that I read in Bloomberg. But some investors may have some concerns about the ETF's outsized exposure to China. So what would you tell those investors?
Yeah, sure. I think what we wanted to do again was just to make sure we're providing a pure play, and we decided that we would just go for the top electric vehicle companies by market cap. One of the other kind of rules that we have in our index is that the company must be listed on either Nasdaq or NYSE, with a minimum value traded of $1 million for 1 or 6 months, preceding the index constitution and rebalance. So that, eliminates BYD. And then in terms of, why is there this kind of excess allocation to China? So it's just, again, that, those 3 names are actually ADRs. They're traded on these 2 exchanges, or, are, in one of the 2 exchanges. And then in terms of, how could that change? Well, if any EV automaker listed on one of these 2 exchanges, whether it's a European company with an ADR or just another American manufacturer, whether it's a GM or Ford or Lucid, if they fit the rules, and the rules are 50% or more of their annual revenue or operating activity has to be identified as electric vehicles, then, they could potentially push some of these names out. So we're kind of we have no bias here. We're literally just doing it by kind of the biggest, the best companies that people want to own in the EV space based on their market cap.
Excellent stuff, Sylvia. We'll have to leave it there. But thank you so much for joining us today and for sharing your insights.
Thank you so much for having me.
That was Sylvia Jablonski of Defiance ETFs. Let's recap the ticker symbols that we discussed on the podcast. So we talked about the 2 ETFs that use zero-day options and to provide exposure to the equity market, as well as they aim to provide some very juicy, outsized yield distributions. So the one which seeks to provide exposure to the Nasdaq 100 is QQQY. And the second one that we discussed is JEPY. It provides exposure to the S&P 500 index and then writes options for those outsized yield distributions. Obviously, the ticker symbol is inspired by the immense success of the JP Morgan Equity Premium Income ETF. Ticker symbol is JEPY. We did briefly discuss that ETF as well on the podcast. And then the electric vehicle ETF that we talked about. It's the first pure play EV ETF, and the ticker symbol there is EVXX. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.